Welcome to another Learning About Loans. Today I got the wonderful, amazing, incredible Miss Tamara Pawalny. Tamara and I have been working together for a decade and a half or longer, which is crazy. She is incredible, one of the most caring people I know, and also one of the most can-do, amazing, incredible loan officers at making just weird things work. So Miss Tamara, welcome again. What are we talking about today, Tam?
We are going to go over just kind of following the steps of what we did last week, our first-time homebuyer and down payment assistance programs.
DPAs, down payment assistance programs. Which one are we talking about? One in particular this week?
Yes, we are talking about TSHAC. TSHAC stands for.
Let me guess. Hold on. Let me guess. Texas State Authority Housing Commission. Did I
I
get that right?
believe it's Affordable Housing Commission.
Affordable makes more sense. Yeah. So in the industry, for those watching, TSHAC is just what I know it to be, but it's a Texas DPA, hence the T, right? For Texas. TSHAC is what it's called. It is what's known as a bond program, and it means they give you money to help you come up with a down payment for closing. So before we get into the details of TSHAC, okay, what program can this be used for? Is this only for first time home? Well, let me rephrase. Let me back up. Is this only for first time home buyers, or who qualifies for this? Everybody?
Everybody.
Okay. Are there any limitations on who in terms of income? Because a lot of times there are income limitations on these things.
Yes, this one has income limitations, and it is by household and by county.
So it's real specific, right? So in other words, to really know if you qualify for it, you got to know how many people are in your house, the income of all the household, and where you're buying. So we'll get into those.
Also the loan type.
And the loan type. And it is for all loan types like FHA, conventional, VA.
Yes.
Of course, in theory, VA, you don't need it because you're a vet and you can put down 100%.
But it'll cover your closing costs.
Oh, so
you could use
TSHAC
for VA and USDA.
Really? So, okay. So people can do USDA or VA, which are both 100% financing programs, and include TSHAC to cover closing costs.
Right. Up to a maximum of 3% of what TSHAC offers to cover those closing costs.
You're good. You're good, Tamara. All right, cool. Good to know. All right. So it can cover all the programs. We'll get into limitations in a minute. And you don't have to be a first-time home buyer. So anybody can qualify. Obviously, the house has got to be in Texas.
Yes.
Primary home, not investment properties, not second homes. Okay. Credit requirements. What credit score? Are there any credit score requirements?
Yes, your minimum credit score is a 620. And at the 620, all the way up to a 639, the program also has an additional cost for that. If you're above a 640, there's no additional cost.
Cool. So we'll get into the cost for a second. So cost, how much does it cost if you're 640 and above? And by the way, side note, if you're watching this and you're a consumer, meaning you want to be a home buyer and use this program, and it's only for purchases, I assume, correct?
Yes.
Right. So if you want to buy a home and use this program, your credit score in the mortgage business, mortgage industry, our credit scores are going to be lower than what you're probably used to. So as a consumer, when you look or you subscribe to a third party or your credit card company or consumer credit reports, they're going to be a higher score than mortgage. That's just because the mortgage industry uses a different grading scale. So when Tamara says it's 640 or 620, realize that, again, if you say, oh, I got a 640 at home, like I'm looking at my credit monitoring service, I got a 640. It could be that you have a 600 in our world or even a 5 something. So understand that our scores are different. So don't get mad at us when you call us, but it is 640 on the mortgage tri-merge. So we won't get into those details now, but just keep that in mind. So Ms. Tamara, if it's a 640, we were talking about cost, 640 or higher, what's the cost for this program?
There's a handful of fees and they total approximately $550.
So understand, people, we don't set these fees. They can change at any time. And it's not a company thing. It's a bond program, whatever TSHAC wants to charge. So let's just call it $500 to $700 for grins, for round numbers. And that's paid at closing, I assume, correct?
Yes.
And are there any other fees besides just those flat admin type fees?
Yes. Lenders can charge a 1% origination fee. Most lenders do charge that 1% origination fee just because the loan is serviced through a different servicing company. It's funded through US Bank. And so as a lender, because we don't set the rates, we have no control over the rates. So that is how the lending company like you and myself would pay the processing and underwriting and all of that.
Yeah. So what Tamara basically saying in a very simple terms is mortgage companies, and under the general rule, mortgage companies really don't make very much money on these bond programs. As a corporate, like as an industry, the corporate big dogs are like, we don't love them. They're not going to say they don't want to do them because it's not compliant, and they will do them. Tamara and I love them because it helps folks get into homes. It makes dreams come true. It is great for business. We want to help everybody we can because we get paid to close loans. So Tamara and I love them, but just understand as an industry, these are, for whatever reason, the way they're structured, it's just companies don't make as much on these type of programs, which is fine. But that's why they will charge the full 1% that they're allowed to charge, because that's about the only money. And there's probably some others, but for the most part, that's going to be their profits. And that's why they have to charge it up front to make that money, because they don't service the loans, which is another source of income in the mortgage world. So here, 1%. So for those watching at home, if you buy a $200,000 home and you get a $200,000 loan, $200,000, 1% is $2,000. So there could be a $2,000 fee plus the 500 to 700 ish of admin fees that Tamara mentioned. So we got 1 point, and then we're talking about a 640 credit score or more. So there's a 1 point fee that lenders will charge. I know we do for sure. And every company I've been at before that I can remember also charges the same 1%. And what if it's under 640, Tamara? What if it's at 620 to 639? What changes?
So there's another 0.5% origination fee that goes to TSHAC for the origination.
So again, to repeat, on a $200,000 loan, that extra 0.5 point is now $1,000. So it's $2,000 for the 1 point that the lender makes, and then TSHAC's going to charge you 0.5 point for that credit adjustment. So it's an extra $1,000 that then goes to TSHAC, again, not to the lender. So the fees, admin fees to cover whatever they do from an admin standpoint, and that's on top of normal, air quotes here, normal lender fees, right? So whatever our company charges, other companies charge, they have their normal closing costs. This is on top of other fees that you can do. So yes, you're going to get free money for help on a down payment assistance, but the trade-off is you're going to have fees that come into play, and you're going to pay more at closing in terms of fees. So Tamara, what probably should have asked this out of the gate, how much do you get? That's probably the first question I should have asked. So on these down payment assistance programs, how much can somebody get?
So it really just true. So we do have to check daily what down payment assistance amounts are available, because it is a state funded program. Some of them may not have options available. For example, there is a true grant. For the grant, that is, you don't have to pay back. It's only for FHA, VA, and USDA. And there's only 2% and 3% available right now for the true grant. Now, the true grant does have a higher interest rate. As I always say, there's no such thing as free money. You will pay that money back somehow, but it's giving you that free money that's not tied to a lien or anything at the time of closing. And
So the grant, just to be clear, the grant, sorry to interrupt, the grant right now, and again, subject to change, all that stuff, for government loans, and it can be somewhere between 2% and 3% of your down payment. They can cover 2% to 3% of your down payment. Is that what I mean? Right. Or, and is it only for down payment, or can it also pay for closing cost?
For closing costs as well, because it allows for USDA and VA. Okay.
So if you get 2% or 3%, let's just say it's 3% in our example. So let's say on that $200,000 purchase, and I know that's low and that's not necessarily realistic, but it's easy math. But if somebody does find a $200,000 home, that means they're going to get $6,000 if they get 3%. So 3% times 200,000, $6,000. If the fees are, let's say they got a 620 credit score, and they're about to pay 1.5 points in fees, the 1 point to the lender, 0.5 point for the adjustment. Does that mean their 3% is really like 1.5? Because after you net out those fees, they're really getting about 1.5% of money.
That's correct.
So you guys think about that. Again, there's no such thing as free money, right? You are getting some, you're getting money, and it's awesome. And if this is what you need to get in the home, let's go, green light. But if there are alternatives available, whether it's gift, from somebody else, or whether it's savings or other ways to get it, or other programs, our job is to make sure that we explore all options. But think about it, this 3% they're giving you, if you got a 620 credit score, it's really only about 1.5. So now, because Tamara, you did allude to the fact that the credit scores are higher, we'll get to the interest rates higher. We'll get to that in a second, because I feel like there's still more to this. So on the grant, when it's a government loan, FHA, VA, USDA, when it's a grant, they don't have to repay the money. Is that what I heard you say?
Correct.
So what does that mean? So like, I just get the free money and I close it. I done. What's the alternative? So if it's a conventional loan or not one of the governments, no, doesn't work that way. Fill me in.
So the grant is for the Hometown Heroes and Home Sweet Texas. You have to be a first-time home buyer. And it's only on government funded programs.
So the government ones, like we just said, FHA, USA, VA. But who is a hometown? You said Hometown Heroes?
Yes.
Who's a hometown hero? Give me some
First
examples.
responders, veterans, nurses, teachers, policemen.
Awesome. And you have to be a first-time home buyer to get the grant.
Mm-hmm.
Or is it or and a first responder or all
yes.
that? So you have to be both. You have to be first-time home buyer and
first-time home buyer, or yes,
or so first-time. So to be a grant, first-time home buyer, or one of the heroes, the hometown heroes. And you said a different word I didn't recognize. There was a hometown hero, and what else?
There's Homes for Texas Heroes and Home Sweet Texas.
Home Sweet Texas. What's a Home Sweet Texas?
It's just it's for the first-time home buyers.
Got it. So they just put fun little words on it, which I like, right? First-time home buyer, or think of it as, the heroes being, again, like you said, the cops, the firefighters, the teachers, the police, the nurses, those type of professions. Am I right?
Yes.
Love. Okay, cool. So that's the grant. So you don't have to repay the money. So it really is free money. It comes to you. It's yours. You use it for down payment, closing costs, whatever. You don't have to pay it. When do you have to pay it back? What do those look like? What are those options?
For the grant?
Yes. Not for the grant, but is there something that's not a grant? Is any part of TSHAC where they don't, or where they do have to pay it back?
So that's the next part. That's the actual, it's called a bond. And that is a 3-year deferred forgivable second. And so 3 years of deferment means that you do not make payments on it. Like last week, we spoke about the other program where you did have to make payments. This one you do not make payments on. And it's for 3 years. So on month 37, that loan is forgiven and you do not have to pay it back. If you do anything to the home within those first 36 months, whether you sell or refinance, you do have to pay it back.
Got it. So do you have to be a first-time home buyer, or is that's where everybody can have the bond part?
Right.
Okay. So if you just say, hey, I've bought a home before and I'm not one of the first, the hometown heroes. I have bought a home and I want to use this program. You can still get it. All the fees, I assume, and the costs are still the same, right? The rate's still the same, which we'll talk about the rate in a second. So all that's still the same. The exception is I need to have that mortgage for 3 years, because what you're saying, Tamara, is even if they refinance in that 3-year window, are they going to owe that money back if they pay off that mortgage and they refinance? Because remember, guys, paying off a mortgage doesn't necessarily mean selling a house. It means refinancing is also paying off a mortgage. So if you refinance or sell the house within 3 years, in our example, we've been using the 200 grand. So if you get $6,000 up front because you're getting 3%, then you're going to owe that 6%. Or pardon me, that $6,000 back. So when you refinance, there's a $6,000 tag that something gets added to your principal, or at least a payoff. That's a better word. $6,000 gets added to your payoff, or if you sell it, you're going to owe $6,000 as part of the payoff as well. So you need to leave there for 3 years without refinancing. Good. And you mentioned earlier the 2 to 3%. I think that was for the governments. Is there anything outside of 2 or 3%? Like if you did a non-government loan, like a conventional type financing, can they get more than 3%?
So with the grant, there's only 2 and 3% available. With the down payment assistance, there's 2, 3, 4, and 5% assistance available. 2, 3, 4, and 5.
Got it. So, and again, the grant is free money. The bond program is going to say that you eventually have to pay back if you move within 3 years or get rid of it in 3 years. Longer than 3, you're good, but you can get 2%, 3%, or 4%.
Or 5%.
Or 5. I'm sorry, you were right. So it's 4 different options: 2, 3, 4, and 5.
Right.
So you can get all that money. And again, it can go towards down payment. It can go towards closing costs, whatever makes sense and how you're structuring the loan, correct?
Right.
Cool.
And then in that 3-year forgivable, there are different availability. So right now, the true bond program is unavailable. There is no grants or not grants. There's no down payment assistance available as of today for the bond.
Meaning they run out of money. So at some
Yeah.
point, because this is state funded and other down payment assistance sometimes can be privately funded or however they do it, there's absolutely real possibilities like this very moment at this taping, there is no money available to do this. So
Right.
that's where, again, as great as a program as this can be, it may not always be there for you. So great point to make.
For the non-bond, it does require, that's the non-bond government programs, FHA, USDA, and VA. Your minimum credit score is a 620. And then you can also use it for conventional financing. And the conventional financing goes into 2 buckets.
Okay.
One bucket is the FHA preferred. And that is when your average median household income is above 80%. So the counties will have
80% of
80% of the
AMI.
AMI,
Okay.
average median income.
Yeah. So you
Or
said that. I just want to make,
AMFI.
yeah. So
It's not, it's a family income. So that one is saying that the family, whether your spouse or your girlfriend, fiance, even if they're not going to be on the loan,
if they're in the house,
if they're in the house, we have to count that income.
everybody who's 18 and older, they have to count the income. So even if it's your kid working at the grocery store, whatever they're doing, at the end of the day, you have to count all 18-year-old and up income for the household income.
Right. And
I
it
remember because I got bid on that like
be
19 years ago when I first started doing something. It is the 18-year-old will get you. So be honest, because they will find out and they do digging. So find out. So to repeat that, the AMI, the average, and I don't know if it's average. AMFI, sorry.
Because there's 2 different ones. There's AMI.
Okay. I know that one clearly. What's the AMFI?
Household and average median family income.
Family. That's what the F is. Okay. 80% of the AMFI, the family income. So they're saying in an area, somehow there's some sort of census tract or something. They have a number that says, here's the normal average of the area. You have to be at 80% or less. Is that right to get this?
This one allows you to be above that 80%.
Okay. So this one allows, and this is the conventional. And by the way, you guys can see like how complicated this can get. And this is one of so many things. And that's why, again, sometimes it's just really tough to make sure that if you really have questions and you're like, okay, at this point I give up and I don't care, just call us. Tamara can absolutely walk through it. And again, you can see her looking off to the side is because this is a lot. So going back to, this is for conventional. This is they allow you to go above the 80% area, average, median, whatever it is, whatever the AMFI, the family one, you can go above that.
Yes.
Okay, cool. And what's the other one? You said there were 2 types.
That is the HFA advantage or preferred for below the average median family income.
And you said it was HFA?
Yes.
Household family average? I'm guessing. I don't know. Do you know what that stands for?
I can't tell you.
All we know is it's an acronym that says if you're below that 80%, you fall in that bucket. What's the difference between the two? So I understand how you get to one of the two, right? One bucket's when you're above the average income, household income. One's when you're below. What's the difference? Is there a cost, a rate, the money you get? What's the differentiator? Rate?
The rate is between 1/8 and 0.5% higher if you are above.
Higher than it would be if you were below. So you got to, let's just call it a rate of X, whatever that X is, right? Some thing. So X. And then if you're above the 80%, they give you, which is kind of weird and counterintuitive, but they give you a higher rate if you're above that 80%.
Yes.
So in theory, guys, another way of saying the exact same thing, it's probably the way I would think about it. You get a better rate. Like this rate is probably higher, right? Whatever this is, when you're above the 80, they're giving you a better lower rate if you're below that 80%, because they're trying to help
Right.
home ownership. These things are here to try to be pro families buying homes, things like that. So they're technically giving you up to potentially as much as a half, right? And I'm sure that can change the market, et cetera, et cetera. Overall, the rates for these programs, so whether you're at the higher or the lower, compared to a air quotes normal, right? Whatever that means to the normal. So if normal rates are some amount, these programs are how much higher than a normal rate? Ballpark me. What do you guess, Tamara? Is it half a point, a full point? How much more does it add to the rate if we were to do a bond program?
If you were to do the down payment assistance program, FHA versus FHA regular, it's about 3/4, so 0.75% higher.
0.75. Let's just round up and call it 1% higher. So, guys, if you get free money, as we talked about earlier, there's no such thing as free money. So, if you're going to get this down payment assistance, whether it's a grant or the bonds program, whether it's FHA, whether it's conventional, just in general, if you go looking online and you see rates are this, expect it to be about a point higher when you start throwing in this down payment assistance with TSHAC. But again, maybe it's 0.7, maybe it's whatever. But the reality is just a generic rule of thumb. Let's just go with 1% for today's conversation. So you are paying higher rate because of it. Now, again, if you're below the 80% area household income, maybe it's a little better, a little sweeter. But at the end of the day, just know that it's more. That's the point we're trying to make. Cool.
And they do change these every so often. And the income limits for the government and the above the 80% average median income versus the versus other ones, they will be on the website, but sometimes it's hard to navigate. So if you do have questions, I always keep a copy saved on my desktop. I update it every few weeks just to make sure that nothing has changed, but typically it gets updated once a year.
So again, typically once a year, but certainly could change. That's the qualifier there,
Right.
or the disclaimer. But the reality is, to Tamara's point, you can go to TSHAC's website. So TSAHC, is that right? All right.
HC, TSAHC.
Say it one more time, just so everybody can hear it.
TSAHC.
Perfect. Go to that website or just Google it and find it. And there'll be income limits, or the area limits, and they'll tell you where you are above or below. Tamara, if you had to guess, because again, as you heard earlier, it also varies by county. Just an average. Are we talking like household average income of 80,000, 100? Like, where do you think that kind of that range is for how much before you're above or below? Just so we have an idea to kind of walk away with. 80 grand?
So if you are in a non-metropolitan county,
okay, you're out in West Texas somewhere, living the good life, simple life. You don't have a ton of stoplights. Got it. Let's go somewhere out there.
and it's you and your spouse only,
Okay.
then if you make over $91,000, you won't qualify.
Okay.
You make too much.
Too much money. So it's weird. These programs, if you make too much money, they're going to say like you can't get the better stuff. So again, it's really you'd think, man, I should qualify and it should get cheaper and lower. But again, these programs are to help those that need the help. And they're the way these things are set up, they're going to say, hey, if you're living out in West Texas, the two of you in a house, the reality is if you're making 100 grand, you don't need the help and you shouldn't need the help. Is kind of what the program's saying. So in the Dallas-Fort Worth, the Metroplex, you're here. What do you think that number is? So if it's 90 something out there, what do you think it is here in the Metroplex?
If it's you and your just you and your spouse, it's 110,000.
110. So if you add
you and your spouse and a kid, it goes up to just under 127,000.
Okay. And the kid, you mean an 18-year-old, or kid mean like an 8-year-old?
It's household size. So
okay. So it takes into account head count in total, right? So if you have 3 kids, I'm going to guess it means you can even go more income if it's 3 kids. No?
Yes, so it's
Oh,
1 to
true.
2 and then 3 plus. That's it.
1 to 2. So if you have 1 to 2, it's the same number. If it's 3 and more, they're going to bump up. So in your example, I heard you say something about 120. So I'm making this up. So at 130, at 3 plus kids, it might be 130, 140, something like that.
No,
No, way off.
no. If you have 4 kids, your maximum is 127,000.
Got it. Okay, there you go, team. So all that's to say, to do a recap, let's go back to cost, right? Cost to do these things. You're paying at least 1 point to a lender to do it, right? Because the lenders are going to try to make some money because they need to, right? It's not a charity. They're here to make money and stay in business. You're going to pay $500 to $700 ish of admin fees to TSHAC. TSHAC's going to charge an extra half a point if it's 620 to 639 credit score. It is for interest rates. We're going to say ballpark about a 1 point higher than whatever normal program you'd be doing. Could be less. And if you're below 80% of the average family household income, if you're 80% below that, your rate can get a little better. If you're above that, there is a chance you could make too much money. And they base it off the number of heads in the house. And it's also based on, again, family income. So an 18-year-old that has a job is going to be included in that number. Mom or dad living with you with Social Security is going to be included in that number. So household income is going to be all that. If you make too much based on these limitations, you're out. Credit scores, we talked about the 620. There are for conventional financing, you can do, it's a bond, which means you do have to repay it if
It's a non-bond.
It's what's that?
It's called a non-bond.
Say it one more time. Sorry.
Non-bond.
Non-bond is what it's called. Okay. You do a non, it's weird. The non-bond on conventional, you can get 2, 3, 4, or 5% assistance. And you don't have to pay it back if you have the mortgage for longer than 3 years. Yes. Under 3 years, you got to pay it back. For the government programs, FHA, VA, USDA, you can get 2 or 3%, and that can be a grant where you don't have to pay it back once you close. Did I just nail that? Because that was a lot.
You did.
Frick, you're so good at this. Awesome. All right. I feel like we've hit a lot of questions and a lot of good stuff, and I don't think I've missed anything. What do you have? Do you have any points that I've missed or that you want to reemphasize or something we forgot to talk about? I feel like we crushed it. And by we, I mean,
we answered everything. I was just going through the frequently asked questions really quick just to make sure that I didn't miss something.
Smart.
Because, they always have really niche things on those that you don't really think about. You do have to, even if you're not a first-time home buyer, you do have to complete a home buyer's certificate course.
Everybody does.
Everybody does.
That's right. And I did forget the recap on the first. We'll go back to that. So on a how long does that counseling or whatever that course is? How long is that? Is that an hour? Is it 4 hours?
There are free courses, and then there are courses that you have to pay for, and they range anywhere. I want to say
I had $100 in my head.
They're like 3 hours. They used to be 1 hour, but now I think they're longer.
Oof. Okay. So 3 hours, you got to sit there, and it's online, I assume, right?
Yes, there's online and in person. But we do give you a list of both options available. The ones in person, I believe, are longer. The ones online are self-paced, so you can go as fast as you want.
I will say this, guys, like as I hear this, I'm like, oh, that stinks. The reality is these are probably really good, informative classes. I have not personally done one. Tamara, have you had any feedback from people that do them? Have they come back and said, man, that was worth it?
No, but I've never had anybody complain. I've never had anybody say it was worth it, but I've never had anybody complain after they've done it.
Yeah, it's kind of like, you know what? It's good for you. And while you're not going to come out of there just, feeling all smiles and is the most fun you've ever had, the reality is it's probably good for you in the sense that it's good reminder, good education. I'm sure they try to make it as entertaining as possible. So that's a really good point, Tamara. I like that. And cost, we think $100, 200 can be free sometimes. What do we think the top end is if they had to pay?
I think free to 50.
50. Okay. So we'll say $100 just for grins, cover ourselves. Let's go worst case, $100, 3-hour class, whatever it may be. Hopefully it's not longer than that. You can do virtual or in person. And that's if you're a first time home buyer. Is that what I heard you say? Or that's everybody. That's everybody.
That's everybody.
Everybody, doesn't matter. So then going back on my recap, because I did forget to state that the grant programs, which are the government ones, FHA, VA, USDA, the grant ones where you don't have to pay back the money, you do need to be a first-time home buyer or a hero in the sense that it's a cop, fire person, nurse, teacher, etc. The hometown heroes. Is that correct? So
Correct.
if I'm not a first-time home buyer and I'm not a hero, that's funny to say, but if I'm not a hero, then can I qualify for the grant still? Probably not. Okay, I didn't think so. Then I do the non-bond. Is that right? What you said?
Right.
Then I do the non-bond type. Okay, cool. Dang, girl.
And then again, the assistance is always based on your loan amount, not on your purchase price. So, for example, conventional offers 3% down financing. And so you're like, okay, great, I'll do the 3% assistance. Yeah, it's going to be 3% of the loan amount. So you're always going to have a
little
slight difference out of pocket. So I always lean towards the 4% because it's going to cover all of your down payment plus some of your closing costs.
So what she just said is so important, and I wanted to restate that. So if you do conventional financing and the down payment is 3%, it's off the grant. Because again, so let's take some numbers again, the 200 grand. The conventional, if 3% down, that program is going to say you need $6 grand for a down payment. So what Tamara's saying then, that makes your loan amount 194. The 3% money coming from TSHAC is 3% of 194. So you're going to have a small gap, which is why she recommends the 4% to get those few extra dollars to make up that $6,000 to cover that. Great point, Tamara. Great point. I'm telling you,
can also
girl,
combine this program with credits from the seller, from your realtor and everything else. So that way, if that interest rate is a big deal to you between that 3 and that 4%, if you have a seller or your realtor is willing to pitch in money to help cover some of the rest of those costs for you, then you only have to come to closing with the remaining portion of your down payment.
And I think what you didn't mean to, you snuck it in there. The other part that I didn't ask earlier, which is so obvious, your interest rate goes higher with the more you borrow. So if you go for the 2% or the 3% or the 4% or the 5%, if you take 5% gift fund, or not gift, but down payment assistance funds from TSHAC, you're going to pay a higher rate if you take 5 versus 3 versus 2.
Yes.
So the higher you go, the more you take. So what Tamara's saying is they do allow for seller concessions. They allow for third-party concessions, like a realtor, if that's something that they want to do, or a builder, or whoever it may be. They do allow for those concessions to come forward. Gosh.
And the
Tamara,
last
piece, I don't know how long we've been going, but this is intense, but keep going. This is awesome.
The very last piece is, in addition to there being income limits, some counties also do impose a price limit on the amount of house you can borrow, like
really?
How big of a house you can buy.
That's interesting, because you think the income limits alone would be enough to cap that, but you're saying at some point they're going to say this. That's wild. I don't have a good reason why they would do that. Do you have any speculation as why that's the case?
A lot of it, the limit really kind of falls around the max that would be allowed for FHA. So your max loan amount, because most of this is used for FHA.
Okay.
But also because I would say
Tamara speculating. So this isn't mortgage talk. This is now just two people trying to figure out why there's limits. What's your guess?
I'm speculating because I think that if most of these are first-time home buyers or people that haven't had ownership for a really long time, and they don't want you to be house poor. They don't want you to get into a mortgage that would be detrimental to the rest of your finances.
So we're gonna call that trying to protect you from yourself. I think there's some truth to that. I also think, I'm a capitalist and say, you know what, let me do what I want to do, but I understand it. They're giving you money. So if they're going to give you money, they get to set the rules, right? Under my house, my rules. You remember that when you were growing up? Well, now that you're, so if you don't want it, don't take their money, go somewhere else. So I agree with you, Tamara. That makes a lot of sense. And I think the other thing to point out here is, again, as we said from the very onset, these are fantastic programs to help people get a start. And a first-time home buyer, just we haven't said it in this episode, is somebody that hasn't bought a house or lived or owned in a house, not lived in, but owned a house in 3 years. So if somebody bought a house and they sold it and it's been longer than 3 years since they've owned a home, they're considered a first-time home buyer in the mortgage industry. So again, the idea here is you're helping somebody get in there to establish the home ownership so they can get all the benefits of, one, just the simple emotional and stability and all that stuff that comes with just being an awesome homeowner, but the financial part, which is paying down a mortgage, tax write-offs for interest and taxes, property taxes, and then the appreciation. So it's a great way to get in the door. If there's another alternative, we'll certainly explore it. Not because, we're trying to steer you one way or the other, but again, want to make sure we pick the one, or at least present the ones that are available to you. We will certainly give you our 2 cents, but Tamara and I both have been working together now for 15, 16 years, whatever it's been. Both want to make sure that we give you the right information to make the right decision for you and your family and just overall financial needs. So Tamara, I'm not gonna lie, I'm a little exhausted. This is a lot, but this is awesome. You're amazing. You're incredible. I've said it. Again, we've worked together for a long time and you still continuously amaze me. So I appreciate you so much for joining us. I know you got a lot to do today. Thank you everybody for watching another Learning About Loans, learningaboutloans.com if you want to check out more, and we appreciate you.
Thank you.